Snowflake is down around 18% over the last few days after reporting their earnings with a shock announcement. We're going to see today's episode why this could be a great opportunity to buy this incredible growth company. As always, we'll take a look at their top line revenue as well as their bottom line net income growth. We'll look at this company that does have a very strong balance sheet, their total cash versus their total debt for a quick health check. We'll also see how they've compared to other companies in the industry over the last few years. We'll look to the institutions to see if they are still buying this company in the more recent quarters and over the last few years. We'll also run through some of their financial metrics to see whether or not this company is improving on their efficiencies and seeing how well this company is set up for the next few years. And we'll discuss some of the massive insider selling that we have seen, notably by the ex-CEO over the last few weeks. And we're going to take a look and see exactly why this stock is down, what the effect is for the future, and whether or not this could be a great opportunity. And don't forget, we're going to run them through the valuation model, getting to our intrinsic value based on our margin of safety to get to our acceptable buy price and see what Wall Street are forecasting for the next 12 months. So taking a look at that shock announcement, we see that Snowflake say that their CEO Frank Slootman is retiring, and the share price at that point dropped nearly as low as 25%. He was the person who took the company public in 2020, and on top of that, what they have done is lowered their forward guidance. They believe that their revenue in Q1 will be between 745 million to 750, which is lower than the 759 million that the analysts were expecting. Now, something just to point out, this is what we do see quite typical when CEOs do step down or do retire. They essentially lead the path for the next CEO to smash their following quarterly earnings, and it looks very typical. They've reduced their earnings guidance for revenue, so I would be surprised if they don't beat this in Q1. And on top of that, what I want to point out here is over the last 4 quarters, they've beaten on both the earnings per share and the revenue quarter on quarter. So this is a very strong company in meeting analyst expectations and really surpassing them very, very strongly. In fact, their earnings per share 35% in January 24 versus the 18 cents expected. And even on the top line, we can see here that they did beat as well, 774 million versus the 759. So this is a company that continues to beat on their earnings and their revenue by quite some way. Yes, a little bit disappointing that their CEO is retiring, but in my personal opinion, a premium of negative 25% to the share price does seem ludicrous. So let's find out if this is a strong opportunity to add this growth company. Now, it is up around 22% over the last year. And we can see over the last 5 years, in fact, it was trading at around $253 in 2020. It's currently lower than that, and we do see its all-time highs just under $400 in 2021. Right now, though, currently trading in the midpoint of the 52-week range. So let's take a look at this company, their top-line revenue. In January 2020, 265 million reported on that top line. January 2024, so their latest accounts, 2.8 billion. So this is a company that is increasing rapidly their top line year on year as well, we can see there. So this is something very positive to see. We're going to look at the last few years in percentage format too. Now, what is a little bit disappointing, although you could argue with a lot of companies that do increase their top line rapidly, they haven't yet released a net income. So we see a net loss in 2020 of 349 million. And we can see in their latest accounts, even though their top line has increased dramatically, we do see here a net loss of 836 million. So something to consider as we do go along. Yes, their top line is increasing at a very rapid rate, but they haven't yet got to that bottom line net income. But we'll talk about shortly why that isn't a massive issue just in this moment. Now, in terms of the health of the company, a quick health check, total cash versus total debt. They had 434 million worth of cash and short-term investments in 2020. That latest annual report, a lot more at 3.8 billion. So they have increased their cash position quite substantially over the last few years. Total debt then numerically and directionally, it has gone from 211 million in 2020 to 288 in their latest report. So in fact, yes, their total debt has increased, as we can see here, by around 77 million, but they can pay that off in one day if they needed to, with their total cash position much, much larger. So what about some of their competitors in the internet service and infrastructures? We have Shopify, Cloudflare, as well as a few well-known others. Now, over the last year, we actually see Snow up 22%. One of the worst performing, as we can see, only better than VRSN, but still, nonetheless, over a yearly performance, 22% isn't too bad. Over the last 5 years, however, what we do know, as we did see, they have come down from their all-time high. They are currently trading negative 26% over the last 5 years. But remember, past performance is never an indicator of future performance. Now, in terms of institutional ownership, it does sit at 64%, 5.8 billion worth of sales by the institutions over the last 12 months, but a bit more buying, 7.5 billion over the same time period. So we can see over the last year, institutions are buying more than they're selling. And what is good to see, in Q1 there was more selling, but in Q2 we can see relatively flat. But over the last 2 quarters, and even in the more recent quarter of Q4, institutions are buying more shares of Snowflake than they are selling. So they do see this as a strong company for their own portfolio. But please remember that not copy the institutions and always do your own due diligence. Now, we've looked at insider buys and sells at least 100 shares over the last month. And what we can see here, so with their CEO who is stepping down, Frank Slootman, we can in fact see over the last month, he has sold a ton of shares, which does equate to around 70 million worth of dollars. Now, we also see selling by other members of insiders. We have the Chief Revenue Officer as well as the Senior Vice President of Product Management. One thing I would say here is, I know we typically say that insider buying is a bullish signal as insiders buy because they believe the share price will go up. But with insider selling, it isn't necessarily a bearish signal. Insiders sell for many reasons, personal, private, and we can see that the CEO has sold his shares. Quite a significant amount as well, 70 million. So just something to bear in mind. But I personally wouldn't say it's a massively bearish signal. Always good though to consider, but I would say take it with a pinch of salt. Now, before we jump into some of the financial metrics, just to let you know, we are releasing another free weekly article today. We have access to all of our other free articles. If you want to gain access, just click on that pinned comment below. Once you sign up, you have access to a lot. So, free cash flow per share, this is what I quite like to see about a company. Yes, they aren't making a profit just yet, but their free cash flow per share is moving in the right direction. 2019, negative 388, and we can see 2024, 229. In fact, it is moving in the right direction. 2025 expected to go higher. So this is a positive sign that free cash flow has gone from negative over the first few years to a positive. Sales growth, now as always, yes, typical companies 3 to 7%, with tech companies, with companies that are startup increasing very rapidly. This is very common to see, triple digit increases, very, very strong. But one thing I would say, it does look like it has started to slow down, pretty much every year reducing. Something just to keep in mind, just because a company has increased at a rapid rate before, it's not necessarily that they're going to continue. So just something to bear in mind, especially when we start to look at the valuation. Nonetheless, they have increased that top line significantly from 100 million in 2019 to 2.81 billion in 2024. Shares outstanding. Now, yes, we don't like it when companies essentially issue shares. That does dilute our position as a shareholder. And we have seen that here, although it is typical with these smaller companies at the beginning. 38.2 million in 2019, 328 in 2024. In terms of the ROIC, now this is going to be negative given the fact that they have made a loss over the last few years. But what we ideally want to see is around 10% as a minimum on a positive side, as that gives us faith that management are able to effectively allocate their capital. The one thing I would say that is positive with their margin, we can see their operational efficiencies are increasing over the last few years, and hopefully it isn't too long before we do see a positive operating margin side, so we can see that essential positive net profit. Free cash flow margin, nice to see it has gone from a negative to a positive, looking very strong over the last 2 years. And again, this is the direction that we want to see that operating margin follow into in the subsequent years. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This shows us essentially the balance sheet strength, which we already ran through, essentially showing over the last few years it wouldn't even take them 1 year, or in fact 1 day, to pay off all of their debt net of cash on hand. 2025 expected to be the same as well. So let's jump into the valuation of Snowflake. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the main valuation that we're looking at for Snowflake, which is the DCF model. Now we have their free cash flows year on year. Average growth rate at 74.2%. Now forward looking, they are estimating between 30 to 40% based on those numbers. But again, this is a very subjective number. It does come down to what you expect over the next few years and over the longer term, over the last 10 years, if you think they will continue to grow at a rapid rate. So based on this estimate, we have that with our discount rate. We get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to that equity value, divide by shares outstanding to our intrinsic value, which shows our signal of undervaluation. Now, just to show, if for example you think that is too high and you want to be more conservative, you could lower that to say 25%, and that would reflect in the intrinsic value. Likewise, if you think they will get to the upper end of 40%, you can see here that the intrinsic value would be much, much higher. So we've gone for the lower end of the 30 to 40% analyst estimates, as well as what management see over the next few years. So that gives us the intrinsic value, as we did mention over there. And in today's episode, that is $228. Now, as always, you can grab a copy of this model if you want to run your own companies through to get to your own acceptable buy price and intrinsic value, whether that's those on your watch list, in your portfolio, or even if you want to run through these numbers on screen with your own estimates and judgments. Now then, we start off with a margin of safety with these companies of 10%, and we use that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If we believe that, then it is acceptable by up to $206, and we keep going up till it's near the current trading price, and we can see it isn't too far off a 20%. So right now for Snowflake, we see around 15 to 20% as that margin of safety level. In terms of Wall Street and what they forecast over the next 12 months, well, they have a price target slightly higher than our intrinsic value of $230. They see upside of 23%, so they do see this right now as a strong buy to the portfolio. As always though, do let me know your thoughts in the comments below, whether or not this is one you are looking to add to your growth portfolio. Maybe for one reason or another it isn't. For example, if you do believe that the CEO stepping down is essentially a very, very, very justifiable factor for that 25 to 20% drop. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, I'll see you on the next one.